Last trading week finished with the publication of unexpectedly weak employment data in the US, yet traders reacted positively to this news. Stock indices resumed their growth to finish the weekly session at new highs. Negative data from the labor market eased fears that the US Fed will cut its mass support measures in the near term. This in turn has spurred the demand for risk assets. The US dollar index, which measures its value against the basket of 6 majors, closed this week with a decline of 1.13% at 90.20. This was the worst week for the US dollar since November 2020. In April, just 266,000 new jobs were created in the US, which is much lower than the forecast of almost 1 million. The news increased uncertainty around the recovery in the US labor market and reinforced expectations that the US regulator will be extremely flexible in providing support measures until the economy recovers. Not so long ago, market participants took into account the comment by US Secretary Treasury Janet Yellen. She said it was necessary to raise the interest rate to prevent overheating of the economy. Now it became clear that a rate hike will be a hasty step to make. The euro-dollar pair finished the trade rising to a 2-month high above the level of 1.2150. The euro is rising against the dollar amid market optimism over economic recovery and signs of accelerating pace of vaccination in Europe. Besides, strong macroeconomic data was published last week in one of the leading European economies. Industrial production in Germany rose to its maximum value in March since October of the last year, and data on foreign trade signals a recovery in global demand. The British pound also took advantage of the overall weakness of the US dollar. The sterling approached the psychologically important mark of 1.4000 against the greenback. On Thursday, the Bank of England left its monetary policy unchanged and announced a slowdown in the pace of purchases and signaling it's on course to end emergency support by the end of this year. The central bank has also raised its outlook for UK GDP growth to 7.25% in 2021, compared to the previous forecast of 5%. In its forecast, the regulator considers the easing of restriction measures and a swift rollout of the COVID-19 vaccination program in the country. This will ensure a faster than expected recovery from the coronavirus crisis. Meanwhile, Bitcoin spent another week trading in a sideways channel of a fairly wide range. The price of the number one cryptocurrency declined to $53,200 per token. Despite a popular idea that Bitcoin is a means of wise investing, Elon Musk wrote in one of his recent tweets that it is necessary to be careful when investing in cryptocurrencies. Anyway, analysts still expect Bitcoin to continue its rally and rise above the mark of $60,000. Oil closed last session with gains in its second consecutive week of growth. Crude inventories in the US dropped sharply in the previous week, pushing Brent price to the level of $70 per barrel. Easing of restrictions in the US and Europe, as well as strong economic data from China, also improved the market sentiment. At the same time, there is threat of rising COVID-19 cases in India, the world's third largest oil importer. Meanwhile, gold rallied above $1,840 per troy ounce, first time since February, amid disappointing payroll report that scared investors away from the US dollar and caused a sharp decline in the US Treasury yields. The precious metal also benefited from the demand for safe haven assets amid the ongoing coronavirus crisis in India and Japan. As a result, gold posted its biggest weekly gain since November, having added 3.5%. You've watched combined review of currency and commodity markets on InstaTV with me, Anna Kasatkina. Subscribe to our YouTube channel to keep track of all the latest events on financial markets, and see you back soon.